Okay, hi everyone, and welcome to today's webinar. My name's Sam Jacobs from 6 Degrees Investor Relations, and I'll be hosting this presentation from Aguia Resources Executive Chairman, Mr. Warwick Grigor. Today's presentation will provide an update on exploration and development activities at Aguia's fully owned Santa Barbara Gold Project in Colombia, along with a summary of recent progress at the company's Brazilian phosphate assets. After the presentation, we'll commence a Q&A, which will comprise both written submissions and a live questions segment. A copy of the webinar will be available on Aguia's media channels later today, and you can download a copy of the company's latest announcements from the ASX platform. But for now, I'll throw it over to Warwick to kick things off. Warwick, the floor is yours.
Thanks, Sam. Welcome, ladies and gentlemen, to the webinar. Front page basically gives you a very good summary. This is a company with a project at Santa Barbara, tiny capex. It's almost unbelievable. To get to the rate of 50 tonnes per day, which would be 10,000 ounces per annum, we're still looking at total capex of only 2.5 million, and that's quite amazing. High grade. The reason why we can do this is the grades are plus 30 grams in all the sampling. There's been trial mining that's happened, and that grade has been confirmed by recovery of gold. The time frame, if you consider that we only completed the takeover in July and we started getting on ground in September and October, to get to the point where there is a gold pour and we have got a continuous operating plant in the matter of, less than 6 months, that's quite amazing too. So throw in that the exploration potential. We all know that we don't have a JORC resource, but we've got 7 kilometres of veins that we're about to start drilling soon. That's where the real multiple is going to come from. And that will lead to rapid returns for shareholders. It's all about shareholders. It's not about directors. We're very determined to put shareholders' benefits up front and centre. So next one, Sam. Keep going. Right. It's an exceptional gold project. Very high grades, as I've said. Being roughly half a metre wide, you don't use large mechanised equipment. It's a narrow vein air leg mining proposition. That means you maximise grade. You couldn't do it in Australia because of the high labour costs, but in Colombia, it's par for the course. So what we've done, we've got a project where there were 500 tonnes bulk sampled in samples of 50-tonne lots. They were treated over a 10-month period. And that gave us enormous information, very valuable information. If you consider a high-grade gold discovery, you might drill 50, 100 holes. That drilling program might take 1, 2, 3 years, whatever. Eventually, you've got to join up those holes and you come up with a resource. Then the mining engineer will look at it and say, all right, well, you can mine this, you can't mine that. He'll do a mine plan. And most geologists hate engineers getting involved because they reduce the resource. We've seen it time and time again. Once that is done and he's designed a mine plan, you then have to go underground. You don't know what the ground conditions are going to be like. You don't know what the geological assumptions are like because it's all been done on paper. It can take 2 years to open up the underground workings and open up faces. And once you've done that and you've got an idea of the costs and the sort of grade coming out of it, then you can say you've got a mine. And, that could easily take 8 years. What we've done is the other way around. We're fortunate that you can go in with an adit. You don't have to put a decline or a shaft in. And we've developed 200 metres along the ore body. What that has done is showed the geometry of the ore body, which is near vertical. it's shown the continuity of the ore body. Sampling along that ore body will tell you whether the grade comes or goes or whether it's consistent. We've found that with 50 micron gold, as opposed to nuggety coarse gold, the grade is very consistent over that. So we've determined ground conditions and rock mechanics by putting it through a 30 tonne per day rated pilot plant. We've determined the metallurgical characteristics. Remember that when it was going through that plant, they're 50 tonne batches. It's not a continuous operation. So the metallurgy wouldn't have been optimized on a continual basis, but it's still very valuable information. And what we've done through this process is we've answered a lot of these questions up front. We haven't needed to go and do scoping, PFS and DFS studies that end up costing a lot of money, taking a lot of time, and there's a lot of compliance. We've actually figured all that out, not on paper and in studies, but we figured it out in real life. And that's immeasurably more valuable. So we get to the point where there's probably $5 million been spent to get to this level. And when you're drilling out a resource, it can take many millions of dollars and take many years. But we're going to fund that out of cash flow from operations. So it's much better for dilution or avoiding dilution for shareholders. So the other thing is it's a small scale operation. Great savings in infrastructure and in capital equipment. It's just very high profit margin. So we're not chasing scale. We're chasing profitability. We want to maximize that, minimize dilution of shareholders through, we don't want to have to go out and do big share issues. And in fact, we haven't done them. So, and the next step, once the gold is flowing, is to work out what the exploration potential really is. We've got 7 kilometres of map veins. Let's get the drill holes going and figure out what's there. Next slide, Sam. There are a few points. This is all on a presentation released to the ASX. But that gives you an idea of the time frame from the compliance-driven approach that I've just described to you. The streamlined approach for Aguia, we were fortunate someone else did all this work before us. They ran out of money a couple of years ago when the Canadian stock market was really sick. All we had to do was pick up the ball from where they dropped it and get operation in the field. So, that's our timeline. The money was basically raised in July, August 24. Recommissioning the plant started in November and January, and the first gold pour was in January. By April, May, we will be at the continual rate of 50 tonnes per day. Within 2 months, we'll start the first drilling, and quite possibly we'll have a JORC resource in Q3 of this year. And we'll just keep drilling because this is a really big system. We're not going to get to the bottom of it in the first couple of years. So you'll find that's a lot faster time frame. And remember, when companies take years to do something, you've got all those compliance costs. Just surviving costs $1 million a year. We've avoided the cost of that to our shareholders by fast tracking it the way we have. Next slide. I put this in as an educational slide. A lot of the ore bodies that are being started up in West Australia and elsewhere around the world are about 1 gram per tonne. We're looking at 30 grams per tonne as our head grade. And just look at the reasons why high grade is so much more efficient in terms of environment and energy costs. If you're going to produce 1 ounce of gold and it's 1 gram per tonne, ballpark you need 30 tonnes of ore. You've got to truck those over substantial distances sometimes. But not only do you need 30 tonnes of ore, but you're probably going to have at least a 1-to-1, 1-to-2, 1-to-3 waste ore ratio. So you're moving not just 30 tonnes, but 60 or 90 or 120 tonnes to get that 1 ounce. Now that that consumes a lot of energy. If you've got a 30 gram per tonne ore body, depends on how wide your development is relative to your ore body, but you're looking 1, 2 or 3 tonnes of ore that you have to move, ore and waste, to get 1 ounce of gold. Looking at the processing side of the business, for each tonne of ore you put through the plant, it's a universal rule of thumb. You need a tonne of water. So if you're going to put 30 tonnes of ore through a plant, you need 30 tonnes of water. You've got to get that water to start with. When I say they're 18 tonnes, that's assuming 60% recycling of the water. So, but you still need 30 tonnes of water. With 30 grams per tonne, you need 1 tonne of water and 0.6 of a tonnes if you're recycling. So then when you put that in the plant, think of the weight, the amount of material you're moving. It's a lot of electricity that you're going to have to put into the system. With 30 grams per tonne, it's 1.6 tonnes of ore and water. So a simple demonstration of why the costs of a high-grade mine should be dramatically lower than a 1 gram per tonne head grade. A lot of companies make money out of 1 gram per tonne head grade. There's nothing wrong with that, but it's just beautiful to have 30 grams. The other things to consider are surface area that you disturb with the big open pit, tailings disposal. The factors go on and on, but give me high grade any day. Next slide. It's always important to remember that mining assets are not risk-free assets. We're not risk-free. There'll always be things that come along in a startup phase, in a continual phase, that you have to adjust for. Equipment might break. There'll be changes of circumstances, but there'll be geopolitical risk as well. But does the potential reward compensate for the perceived risk? That's what you've got to ask yourself. Is it a good trade-off? But if you look at the risks, you've got geological and discovery risk, exploration risk, a vast array of technical and operating risks, bureaucratic and geopolitical risks, social risk, financing risk, gold price risk, stock market cycle risk, criminal risk, corporate business risk, management promise and delivery risk. Makes you wonder why you're actually in the business and why you're a shareholder, but is the risk-reward ratio appropriate? So it's the quality of your management, how they address those risks, how they compensate. That's where management really comes into it. But then throw in the high grade, you've got such a high profit margin. You look at any 30 gram per tonne gold mine in the world, and its cash costs will be less than 400 US an ounce. Gold price at 2,900 an ounce, that's a wonderful profit margin. So we offer high risk, high reward opportunity. That's what it's all about. Next slide. The share price today, it's about 3.5, it was 3.9 yesterday. Our market capitalisation, ballpark 50 million. Cash was 2 million at the 31st of the 12th. It's come down from that level, but we're at the tipping point now, the inflection point, with cash coming in, whereby we'll start to build that cash balance. Far East Capital, my operating company, it's one of the largest shareholders. William Howe is one of the largest shareholders. Between us, we have the largest shareholdings. An important point to make, William and I are both on half rations. We could easily get paid a lot more than twice what Aguia is paying us, but we've made a commitment to the company that until the cash flow is coming out of the company, we're happy to take half rations. The real money for us is getting that share price up and getting, enticing someone to make a massive takeover bid for us in a few years' time. That's where the money is. It's not taking money out on salaries. We have a completely different attitude to all these lifestyle companies that have got to pay school fees and mortgages. We're different. So I won't talk about myself. Most of you probably have heard of me. I've been in the business for a long time as an analyst. This is the first time I've taken on an executive role. And quite frankly, this is the best thing I've ever seen in 40 years. My career has comprised raising lots of money over decades, handing it over to companies, and my reputation then depends on how wisely they spend that money and how successful they are. It's not a perfect record by any means, but that's why I've decided to go as an executive here, because success is number one in my objectives there, and I don't want to trust these assets to people who might not be as committed as I am. William Howe grew up in the South African goldfields around Barberton, underground gold miner. He's very experienced in developing projects. He developed a coal mine in Indonesia, a copper mine in Australia. He's lived in Colombia for a 4-year stint. He's living there now. And one of the biggest risks in operating a mine in South America or any remote location is the distance from Sydney or Perth. We're not running this out of Sydney or Perth. William is living in country and he's hands-on. And that's first of all a sign of very good commitment, but it's also a way to make sure that, your hands are on. So Ben 6 Degrees, Christina, she was a previous managing director of Aguia when it was really a phosphate company. She's a non-executive now. And Tim Hosking, this is when we get onto the phosphate. Tim is Australian. He's lived in Brazil for 12 years. He's married a Brazilian woman. He's a resident of Brazil. He built Karoon Gas with his father, that Karoon Energy became a plus $1 billion company. Having an Australian like that living on location, again, gives us a very good hands-on management team. Next. You'll see that management changes when I came on board. That's in September 2023. You can see the turnaround in the share price since then. The takeover bid for Andean, which had the Colombian assets, and the recent weakness in the share price, that's come about because of the escrow stock. When we bid for Andean, we put a 6-month voluntary escrow on the shares. Some people have decided they don't want to go to the distance. They'd been in a private company for 2, 3 or 4 years, and some of them have just decided they want to move on. That's their prerogative. So there's a period of greater liquidity right at the moment. I don't see any aggressive selling down, but if people really want to buy stock, if they go into the screen, they could probably get it. But how long the excess of supply over demand lasts, I'm not sure. But, I think it's a short-term consideration. Next slide. So that's the mission statement. You don't often see companies saying it, putting that out there, but quite clearly we want a rising share price. We want minimum dilution from discounted equity raisings. And that's one of the problems with a lot of the juniors at the moment. The brokers will raise money, but at 20 or 30% discounts, which is ridiculous. Any of our raisings, we've never gone through that sort of discount regime. We should be able to be very strongly funded from internal cash flows. That, as I said, the cash flows are starting to come through now, and they'll build from these levels. And we do want to pay dividends. There's no doubt about that. But put into perspective that you can only declare dividends out of audited earnings. We're not going to be in a position to pay dividends before 2026, but as soon as the funds are there, we will look at doing that sooner rather than later. And the fact that both the managing director and the chairman have major positions in the company, that means we're aligned with you guys as shareholders. So how are we going to do all this? Minimal upfront capital costs, fast track to first cash flow, rapid payback, minimal technical risk, and continual expansion opportunities. That's all sort of textbook stuff. Next slide. Looking at that, that's more telling you what we're going to do. I'll let you read that at your leisure. You've probably read it already. I don't have to just repeat it. Go down. Sam? Talked about the management there. Talked about the takeover. And we've had a strategic review of Brazilian assets, which we'll get to a little bit later. Next one. So, looking at that, I've already gone through all that. That's just restating it. Next slide. A picture tells 1,000 words. That's the Santa Barbara gold mine from a distance. You see the council road going along the bottom, short, less than a kilometre, obviously, going up that side of the mountain. You see in the middle there, that's where the plant is and the workings. It's a mountain, but only a little mountain. Maybe it's just a big hill, but it's not at thousands of metres in altitude that a lot of these South American projects are. This is probably roughly 200 metres above sea level. And the ability to go in the side of the mountain like that rather than build a shaft saves us a lot of money in capital costs and capital development. Next slide. That's an aerial shot. The yellow you see there, that's the 200 metres of development along the Santa Barbara vein. Drop down a few hundred metres to the south, you've got the Mariana shaft, and we're putting an adit in there as well. We'll be joining up those two workings over the next few months as we do underground development. That's just scraping the surface. We've got 7 kilometres of veins that we've mapped there. We've done the structural analysis. We'll get the drill rig into that, but there's a potential for something quite substantial. Next slide. They're the first drill holes. We plan to start within a month or two, 27 drill holes to drill 2,500 metres. All of those holes will be less than 100 metres depth, so it shouldn't take too long. The yellow there you see, they're the drives, the adits that we've already exposed. In terms of statistics and reliability of data, when you can walk along an ore body for 200 metres and sample at every metre, that gives you a lot more statistical information and reliability than just narrow intercepts drilled from above. The drilling that we do, we know where to put the holes because we know the orientation of the ore body. It's not greenfields exploration, it's really brownfields. Any results that we get drilling 25 and 50 metres either side of those adits will quickly tie in with the information we already have. And I'm guessing, but I'm thinking by the third quarter, we should quickly have a JORC resource. At that point, we'll be allowed to call it a gold mine, not a gold project, because we'll be ticking all those compliance boxes that the ASX and the JORC code demands. But it's not high risk at all. Next slide. To show what the ore body looks like, this is an epithermal style ore body. Between those red dots, you see the actual ore zone in the hanging wall of the development. That breaks nice and cleanly. When you mine, the objective is to separate the wall rocks, hanging and footwalls, and just put the proper ore body through the mill. Any dilution that you suffer lowers your grade. We want to maximise grade, so our mining method is designed to maximise ore body into the mill. We've got 2 veins that we've developed now. We're about to get onto a third, but there's going to be a lot more. So geometry is good, rock mechanics are good. Next slide. That photograph on the left there, that's the development drive. That's a routine mining scene. It's all under control. The pictures of the plant there, they were before we started recommissioning. They were taken a year before that. The site was in good condition. Those ball mills are capable of probably doing 80 tonnes per hour. The plant's 30 tonnes per hour, but the crushing circuit is probably less than 30 tonnes per hour. When we talk about 30 tonnes per hour, that's what was represented to us as the idealised capacity. But as I said, it never operated continuously. It was in batches. So we've had to make a few modifications that I'll get on to. Next slide. The Buritica analogy. 10, 12 years ago, there was a company called Continental, listed in Canada. It was capped at about 40 million, just like we are. It had a 30 tonne per day pilot plant, and basically it had done almost no drilling. Over the next few years, it did a lot of drilling and went to 2 million ounces, then 5 million ounces, and eventually 8 million ounces. The grade was started out at about 20, 30 grams. With a larger resource, when they're bulking out some of these veins, the grade dropped to 8 to 10 grams per tonne as a resource grade. But they were developing a 250,000 ounce per annum mine when Zijin Mining came along and bid 1.4 billion for 65% of that project. Now, that mine today is producing between 300,000 and 400,000 ounces per annum. Our big picture is to show that we've got a gold system like this. We believe we have. The geologists believe that we have. We've just got to get in there and drill it and make ourselves a big enough target that someone wants to take over us. If it is as big as something like Buritica, then a 10 bagger from these levels is the starting point. It could be a lot bigger. So that's the ultimate prize. So you've got here good cash flow, high grades, but a big picture which should be enough to get anyone excited. So read that at your leisure if you want to know more about Buritica. Click on the links. Next slide. Next slide. We have another project called Eldovia, which we haven't talked about much. We have put out a reinterpretation of the geology a few months ago. There's 34 drill holes there. There's you can see the grades down the bottom. 2.1 metres of 15 grams gold, 6.8 metres, 5 grams gold plus. Look at the copper grades. It's copper and gold. Eyeballing it, we don't have a resource, but eyeballing it, we could probably expect that the mine will produce 3% copper and 5 grams head grade, which is the gold equivalent of about 10 grams. This would be a mechanised mining operation, 2 to 5 metres mining widths, probably cost at least 100 million. The Japanese have put an adit in it, so we've got more than just drill holes. We've sampled lot of good information. We've applied for licenses next door to improve our drilling angle to get in there. But there's a lot of similarities between this and DeGrussa, which took Sandfire to a $2 billion company, primarily a copper company. We will get on to drilling this later on in 2025, and we'll start to get a handle on just how big this is. But as beautiful as Santa Barbara is, this will be more of a conventional high-grade copper gold mine, and who knows what's there. We're still yet to get to it, but it's pretty good geology. Next slide. So that takes us to Brazil and the phosphate. Now, when Aguia bid for Andean, basically it was in a lot of trouble. It didn't have any cash. It had exhausted the goodwill of its shareholders over an extended period of time. I came in and I saw, well, there's got to be something there. There's got to be some value. It was capital at $7 million at the time. At the very least, it was a good vehicle to take over Andean, to take Andean public. That happened successfully. In March, or this time last year, I went to look at the phosphate for the first time, and I really started to understand what a great cash flow opportunity this is. It's more than just a $7 million shell that bid for Andean. There's a great future here. The new management is taking a completely different approach. The old management did a bankable feasibility study, and they were calling on a $25 million capex, which today would be at least $30 million, to produce 300,000 tonnes per annum of rock phosphate for sale within the Rio Grande state. You see that it's right at the bottom of Brazil. It's probably latitude similar to Mudgee or Coffs Harbour or something like that. It's not tropics. It's a very conservative state. It was settled basically by German and Italian settlers, and it's one of the most important farming states in Brazil. If ever you've looked at phosphate projects, you've got some very big projects in Western Australia and Queensland, Northern Territory. They never get off the ground because they're too far away from markets. You've got to ship them thousands of kilometres. You've got to spend a lot of money upgrading to an international tradable standard that will withstand those sort of logistic costs. Ours is much more simple. All of our product can be sold within 300 kilometres radius of the mine and the plant. That area at the moment imports 2 million tonnes per annum of Moroccan superphosphate. There's more than enough capacity in the market to take what we would produce. Moroccan phosphate costs $370 a tonne, $350, $370 a tonne, landed in the port you see there and trucked up to the farming area is additional cost. Our grade's only about 10%, as opposed to 30% for the Moroccan material. But we will have much better economics. What happens is the price is adjusted for the phosphate level, so we don't get $370 a tonne. We'll probably get today, I think that the market price is about $125 a tonne for the rock phosphate. The process to make that is very simple. It's saprolite ore. You just free dig, less than 1-to-1 waste ore ratio. You put it through some screens, put it in a rotary kiln. That reduces the moisture content from 18% to 8%. And in the process, it's very friable. It breaks up the rotation and the heating basically reduces 80% of this product to the size we want. No chemicals. The final 25% would go through hammer mills just to get it all below that 2 mil size. And we bag it and sell it to the farmers. It's as simple as that. In terms of cost, the feasibility study in March said it'd cost $35 a tonne to process. We don't intend to put the plant on the location of the original ore body. We're using a facility which has been in operation for many decades. So we have to truck to that. Just let's go to the next slide, Sam. I'll see what that tells us. They're the ore bodies within a 100, 150 metre radius next to the ore body. That's just that one there. That's the March 23 BFS. They were talking about 54% internal rate of return, 2.9 years payback, capex 26 million, life of mine 18 years. Well, we have significantly improved that. We can get the same level of production for only 5 million in capex. EBITDA would be similar, mine life would be similar. So what we intend to do, go down to the next slide, we'll see, that's that plant there. That's on a complex which has been operating for 100 years by a family company. That circuit produces gypsum as a fertiliser for the farming community, but the owner's not making any money. They want to lease that to us. It costs about $5 a tonne at 100,000 tonne per annum rate. That's based on a fixed leasing cost each month. If we expand the capacity to 300,000 tonnes per annum by spending $3 million on an additional rotary kiln, which would take total capex to $5 million, the leasing cost would fall to a couple of bucks a tonne. So our cost structure would look like this. About $35 a tonne to process, leasing a few dollars a tonne, trucking might be $15 or $20 a tonne. All up, you're starting to look at ballpark $60 a tonne operating costs. If we can sell that for 120, 125, that's a great rate of return. As I said, almost zero technical risk. So we've just announced in the last week a deal with DB. That's the local company that's been operating on this site for 100 years. We would only be using 10% of their facility. But what it does for us, we're getting well entrenched in the local community. Think about it. If we're a foreign company, come in and set up a plant in the middle of a paddock, how much are the locals going to love us? How much are they going to want to deal with us? We're coming in with a family company that's been operating for 100 years. We've got all the engineering support. We've got the fitters and turners, and we're part of the family. You couldn't wish for a better relationship, a better partnership. They've been selling agricultural products and inputs, lime and other things, for 100 years. They want to add our phosphate, our rock phosphate, to their product lines because they're not selling any of that. So they've got all the relationships and the salesmen with the local farmers. All we have to do is produce it, continue with the leasing arrangement with them, and pay them ballpark 5% selling costs. We will get much more rapid penetration of the marketplace using the locals than if we were just foreigners trying to knock on doors and convince farmers that we're good guys, please buy from us. So the business risk of this approach is minimised. The capex risk is minimised. And it's a far better outcome than that publicly released BFS could deliver. So next slide. Well, that's the summary. So that's the end of the slide. There are a number of questions that I can answer now, Sam, if you want to go through those.
Yeah, thanks, Warwick. We've had quite a few questions come through from the floor and ahead of the webinar. I think what we'll do is split them into start with questions on Santa Barbara Gold Project and then follow up with some questions on the phosphate. So just following on from what you discussed in the presentation as well as the company's recent announcements, there's quite a bit of interest in obviously how Santa Barbara is progressing. So this question kind of represents a question from a few investors, but is there an update you can provide at this stage, sitting here at the end of February, just on how the plant is functioning in terms of that continuous throughput? If there's been any processing issues since those previous announcements in January?
Yeah, we did announce the first gold pour, and the first gold pour, that's proof of life. That means the gold's coming out, the system's working, but it doesn't tell you the system's working perfectly. It'd be a mistake to look at the first gold pour and define the future of the company and its production profile on that. What that did show us is that the retention time was too long in the tanks. It was 40 hours when you should really be down at 20 hours. And so once we did that first pour, we shut it down for a couple of weeks to install a thickener. A thickener is a pre-washing circuit that takes away detrital elements and clays and improves the viscosity going through the agitators. And we commissioned that about a week ago. There are a couple of wells that weren't perfect. We had to go back a few days later and fix them. One of the seals had to be replaced. Normal stuff that happens when you commission things. So now that that's working, we've gone onto a continuous production basis. The residence time in the tanks will halve to less than 20 hours. What we also have to do, the original plant had 3 agitators. We put in another 3, but there was a problem with a control board, a circuit board. We've had to send off and get another one made. That will arrive within a week, and we will, certainly by the middle of next month, we'll be operating on 6 agitator tanks. That means we can do twice as much throughput. There are things. So when we first turned on the plant, not everything was there that we needed. We had an outdoor smelting room. We had to do. We had to turn it from a batch operating plant to a continuous plant. We had to put more water storage facilities up. We had to expand the camp. Various things that we knew we had to do to get to 50 tonnes per day, but some of that's been brought forward earlier. So what we've got is the 30 tonne per day idealised nameplate. It's turning that on has become part of a fusion process between also expanding to 50 tonnes per day. We always knew the crusher was going to struggle to do 30 tonnes per day. While the plant was down and while we were putting the thickener in, we still had the mining and crushing going ahead. So we're building up stockpiles, so it wasn't wasted time. Once we get those additional 3 agitators going, we've got another 4 that we'll put on within 6 weeks. The crushing circuit, which will give us way more capacity than 50 tonnes per hour. It'll probably be, 50 tonnes per day. It'll be more like 200 tonnes per day. That'll be installed sometime in April. The that's when we really start humming. That's the final thing to get that continual 50 tonnes per day. But once we get to that, don't be surprised if we've actually got capacity for 60, 65 tonnes per day. It's not an exact science. You turn things on, you get them going, and then you look for what the bottleneck is. There'll always be a bottleneck, and you just work through that. The mining's going very well. We're just going from one shift a day to 2 shifts a day, 2 12-hour shifts, 5 days a week. There weren't a lot of skilled labour force around. We've had to train up these guys, and we've got the second shift starting up now. That shift will be starting to work on the Mariana. We'll be opening that up and rehabilitating that. Santa Barbara's going fine. Next one is Santa Barbara. So I would think, we're stripping gold every 3 days at the moment, and we're building up. Whatever we're doing today, it'll be double that by about March, middle of March, and it'll be double that again by sometime in April. Got to be careful about saying exactly what we're going to do, because the stock exchange gets upset, because we're not a mine, we're a project. We don't have JORC resources, so we're not allowed to have guidance. But what I can say is we're at the point this week where cash flow's coming in, and the cash drain will become a positive cash flow from this point. So, yeah, I mean, always takes at least a couple of months to commission something. If you consider we didn't start this plant until near the end of November, I'm not upset. I'd love to just turn the key on and have it working brilliantly from day one, but that's just not how these things work. So, in terms of gold, I know some of you guys have been wanting to know, well, how much gold did you pour? We've calculated that it should be about 50 ounces, but we don't have that back from the refinery. And someone said, well, how long does it take to weigh a bar of gold? When it comes out as a precipitate. It's in a doré, so it's a black, horrible mess. It's got gold and silver and zinc and whatever else in it. The refinery then refines it, and you get a gold bar. Getting the cash out as soon as possible, getting that poured, that wasn't actually the priority. It's happening this week, and with additional gold that's come out since then. And we'll report that once we've got a few weeks of continual production. We will make a stock exchange release sometime in March saying this is the trend of the gold production. This is good. But we want to get a bit of a track record behind it so that it will give confidence. I don't want to just say, well, this is a gold pour of this amount and this gold pour is this amount. Let's get something that's a bit more realistic, and we'll report it. But the main thing that you need to know is we are actually pouring gold, and with a profit margin like we've got, it's very positive.
Yeah.
And in terms of selling the gold, the first few sales will be made in country, and we'll keep the gold there. Once we're at that high level of production, Brinks will come in and land the helicopter, hand the gold over, title to that gold changes there. It doesn't matter whether you're selling in country or whether you're selling to an Australian company. Title happens there. It's very normal to be, flying gold around the world. You're talking a few days turnaround between Brinks taking delivery of the gold and the risk and us getting our cash. Normally you'd get, maybe 90% of your money up front, and the balance after they've finalised the process. First few exercises, they're not familiar with the quality of our doré and what sort of yield to expect from it. So they need to get a little bit of a track record on that.
Yeah, thanks, Warwick. Comprehensive update there. So just staying with Santa Barbara for now, there's also a few questions on that process of shipping the gold to Australia for final processing. Can you just provide some context around the strategic rationale for that decision and the time associated with that process?
Oh, well, I'm Australian. I trust Australian banks more than South American banks. Probably as simple as that. We do need money for growth. If over the next 3 months, 12 months, 2 years, we will be reinvesting money into the operation through drilling, through continual underground development, opening up new faces and expanding. 2 years' time, don't be surprised if we're actually twice the size, generating something like 80 million bucks a year cash flow. For the time being, we're happy to leave the money in Australia. Eventually, we'll be building up the bank balance in Australia, but there's no fundamental reason for doing one thing or the other. It's still gold, turn it into cash, US dollars, wherever you are in the world. There's nothing complicated about shipping gold across to Australia. The refineries manage that all the time.
Noted. Perhaps lastly on Santa Barbara, turning from operations to that exploration drill program as well. So you might have touched on this briefly. When you do start that drilling, how long do you think until the company can declare a JORC reserve?
I think it'll be Q3. Having that database from the mine already means that the information we get from the drill holes will correlate much more quickly. It's really, you're going 25 and 50 metre step outs and you're just joining up the dots. I'm not a resource geologist, so I can't tell you exactly, but if we get this rig going before the end of March, there are only less than 100 metre holes. We should get a quick turnaround and we'll get an idea sooner. What I'm trying to do, I'm waiting on the geologist to come back to me, we should be able to come up with an exploration target. That will be a range of tonnes at a range of grades. So it's exploration, it's not a resource. But if we can get the geologists to calculate that, that'll give shareholders more tangibility rather than just arm waving and us saying, well, this is a great big system. We'll actually be able to have something to focus our thoughts on.
Yep, nice one. Perhaps lastly here, just with Santa Barbara, questions come through on sort of jurisdictional risk, but do you think that Aguia will be able to avoid some of the gold theft issues that the neighbouring Buritica or the Buritica region in general has seen for those neighbouring gold operations?
Well, that's why I mentioned earlier that our gold is basically 50 microns in size. It's not coarse, it's not free, it's free milling, but it's not visible. What you've got at Buritica and Segovia is coarse gold, physical gold. People can see it, they can steal it, the miners can put it in their pockets. And it's a big security risk for them. They steer through the risk, but it's still a pain. All our gold is microscopic. It can't be stolen. The only way it could be stolen is once it's turned into doré or bars. So we won't have the problems with illegal miners. We won't have crowds of people. So that puts us in a much better position. Security, everywhere in the world, you've got to be careful. You've got to, whether it's diamonds, gold, or I don't think anyone wants to steal lead, but where you've got a high value product, doesn't matter where you are, you've got to have good security. And that's something we're very conscious of, and we have to manage that.
Great, thanks, Warwick. So that sort of caps off on the Santa Barbara aspect of our investor questions. Turning to the Brazilian phosphate operations, quite a few questions have come in on the new partnership with DB, or Dagobert Barcelos. You did touch on this in quite some detail in the presentation, but given how long they've been operating in the market, this question sort of says an existing client base in the agricultural sector. If so, does DB's sort of standing in the industry give Aguia quicker inroads to marketing that phosphate?
Absolutely. Their long experience, their market penetration already means we just join their team. We pay them a commission. We are going straight to their customers. They'll be opening the door of those customers. So that will accelerate our ability to penetrate into those markets. Not a problem.
No question. And what about just with the phosphate? This question's come through. Are there any offtake agreements you think could be in the pipeline at this stage for phosphate?
We haven't considered that. An offtake agreement would be something to think about later on. When you sell the phosphate, you basically, it's consumed in twice a year where the farmers decide to fertilise their fields. We would need to build up stockpiles, bag stockpiles, and have 2 campaigns of selling. It's quite normal in that industry that you will you will sell earlier at a discount to help your cash flow. That's normal. There's been no discussion of offtake agreements, but the resources we've got, there's over 100 million tonnes there, including fresh rock. We're only looking at these saprolite, but if you really wanted to scale it up, that's when you look at it. But to start with, let's just get the cash flow going. And what I should say, for the first $1.5 million of outlay, our projections are that we'll make between $6 and $8 million a year free cash flow from Q3 this year. If we take it to 300,000 tonnes per annum with a second kiln, so the total capex gets up to $5 million, we'd be looking at $25 million a year free cash flow. So, you know, as much as we're focusing on the gold, the phosphate will have a very strong internal rate of return and strong cash flow. And all the money we need to advance the phosphate, we anticipate that will be able to come from the gold mining operation. So, you know, you never say never, but if at any stage over the next few months we need additional cash, it's to accelerate things. If the mine's not, you know, in a perfect world, the mine will deliver all we want, but maybe it's an idea to have a bit of working capital along the way so we can accelerate the phosphate as well. But you know, we want to minimise dilution to the shareholders. That's for sure.
No, absolutely. Thank you, Warwick. So I think, you know, turning to your presentation, you certainly covered off in some detail on the company's planned operating costs for those phosphate operations with respect to that previous bankable feasibility study from March 2023. So we're just coming up to the hour mark. We might round it off there, but perhaps we can finish off with this question's come through from a more bullish investor, perhaps, but assuming things working roughly to plan, and you did mention dividends during the presentation, but if all goes to plan with the company's development strategy, can we talk about when Aguia would expect to begin paying a dividend?
We should have sufficient earnings for the year 25-26, sufficient profits that we would be able to declare a dividend after the release of those accounts. So probably the earliest is late 2026 in a perfect world.
No, that's well noted. Thank you, Warwick. Well, that just about wraps up for today's webinar. So thanks again to Aguia Executive Chairman Warwick Grigor for the presentation and taking the time to answer those questions. Thanks also to our attendees and everyone who submitted to that live Q&A. Apologies, still a few questions on the floor, so apologies to those attendees if we didn't manage to get to your question, but we had to summarise sort of plenty of interest there. So as mentioned earlier, a recording of the webinar will be available on Aguia's website and media platforms later today. Warwick, just before we go though, are there any final comments that you wanted to add?
I'll finish off with a line that I use when I'm presenting to investors overseas and in Australia. I say, if you're a shareholder, I'm very pleased. If you're not, and if you decide to become a shareholder, I'll be working for you. You'll be my boss because as a director of a company, I'm working for shareholders. And that underlines our attitude. We're, we're a different company. We're a lot more committed than a lot that I've seen. And I think Rome wasn't built in a day, but it's going to look pretty good when we finish building it.
Well noted. Thanks, Warwick. Okay, that wraps things up today. Thanks again to our presenter, Warwick Grigor, and today's attendees. See you next time.
Thanks, Sam.